The stock market has just endured one of its most brutal days since the pandemic. Investors watched as major indexes fell sharply, driven by a wave of fear sparked by new tariffs. It is being described as one of the worst trading days in years, but while headlines focus on panic, history suggests that such moments often present rare opportunities. This video explores why the market is crashing, how long the downturn might last, what history teaches about recoveries, and which investments could prove most rewarding once the storm passes. The latest sell-off began when the United States announced sweeping tariffs on a wide range of imported goods. Chinese products entering the U.S. were hit with an additional 34% tariff on top of existing charges. Imports from the European Union faced 20% tariffs, while goods from Southeast Asian nations like Vietnam and Cambodia were taxed at rates between 46% and 49%. These measures are significant because the European Union and China together represent about 1/4 of all American imports. Add in Southeast Asia, a major source of textiles, electronics, and machinery, and the result is clear. The cost of imported goods is set to rise dramatically. Higher costs eventually flow through to businesses and consumers, squeezing profits and reducing spending. The tariffs are not random. They are part of a broader economic plan put forward by policymakers in Washington. The strategy has three main pillars: using tariffs as leverage in trade negotiations, enforcing so-called reciprocal tariffs to level the playing field, and weakening the U.S. dollar in a way that boosts exports while still preserving its global reserve currency status. The first step, using tariffs to pressure other nations into new trade deals, has already played out. Earlier tariffs on Canada and Mexico were seen largely as bargaining chips tied to broader issues such as trade deficits and border security. The second step, reciprocal tariffs, is where the current trouble lies. In theory, reciprocal tariffs are simple. If a country imposes a 20% tax on American steel, the U.S. matches that with a 20% tax on their steel. The idea is that no country benefits unfairly, and eventually all parties reduce tariffs to avoid mutual harm. In practice, the system has been implemented differently. Instead of matching tariffs directly, rates have been calculated using a formula based on America's trade deficits with each country. For example, in 2024, the U.S. imported nearly $439 billion in goods from China while running a trade deficit of $295 billion. Dividing the deficit by total imports gives about 67%, and having that produces the 34% tariff. This approach has little to do with actual tariff rates set by other countries, and instead penalizes partners simply for running trade surpluses with the U.S. The problem is inconsistency. Some countries, like the United Kingdom, actually run trade surpluses in favor of the United States. In other words, they already buy more American goods than they sell. Yet under the formula, they still receive tariffs, often at 10%. More than 100 countries are in this same situation. Not only is the system not truly reciprocal, but it also leaves trade partners unable to calculate how to respond. Unsurprisingly, other nations are retaliating. China has already announced 34% tariffs on American goods, and similar measures are expected from the European Union and others. These countermeasures hurt U.S. exporters, reducing demand for their products overseas and directly impacting corporate revenues. For investors, lower revenues often translate into falling stock prices. This connection between tariffs and the stock market explains much of the current sell-off. Rising trade barriers make global commerce more expensive, increase uncertainty, and reduce profits. Investors respond by pulling money out of stocks, driving prices lower. The next question is how long such declines usually last. Looking back at more than 70 years of market history offers some perspective. Since World War II, bull markets, periods of rising stock prices, have lasted on average about 4.3 years, delivering total gains of more than 150%. Bear markets, periods of decline, have been far shorter, averaging around 11 months with losses of roughly 32%. That means bull markets are more than 4 times longer than bear markets and create about 3 times as much growth as bear markets erase. This is why many long-term investors see crashes as opportunities rather than disasters. While declines can be painful in the short term, they allow disciplined investors to buy shares of strong companies at discounted prices. When the market recovers, as it always has in the past, those who invested during the downturn often see the greatest returns. A deeper look at past bear markets shows that they can unfold in different ways. For instance, in 1956, the S&P 500 dropped 21% over 15 months and then needed another 11 months to recover to its previous highs. In contrast, during the pandemic crash of 2020, the market fell 34% in just 1 month but recovered within 5 months. The average bear market takes about 13 months to bottom and another 2 years to fully recover. Even the shortest bear markets last months rather than days, which gives investors time to plan, build cash, and prepare to invest. But when is the right moment to act? One useful measure is CNN's Fear and Greed Index, which compiles 7 different market indicators into a single score. The index ranges from extreme greed to extreme fear. At present, it shows extreme fear, one of the lowest levels seen in the past year. For contrarian investors, such conditions often signal a good time to start preparing for future opportunities. Other indicators also help. Market momentum, measured by comparing the S&P 500 to its 6-month moving average, shows whether prices are trending upward or downward. Currently, momentum is negative, reflecting the impact of tariffs. Volatility, measured by the VIX index, is another tool. The VIX spikes during sharp declines and stabilizes as markets begin to recover. A combination of stabilizing volatility and improving momentum is often a sign that conditions are shifting from fear toward opportunity. With this backdrop, the focus turns to which investments may offer the best long-term potential. One starting point is broad index funds such as those tracking the S&P 500 or NASDAQ 100. These funds provide exposure to many leading companies at once. The NASDAQ, which includes major technology firms, tends to fall harder during downturns but also rebounds more strongly, creating larger opportunities for investors who buy at low points. Beyond indexes, several individual stocks appear particularly attractive. Alphabet, the parent company of Google, is trading at one of its lowest price-to-earnings ratios in recent years. Analysts estimate that it is more than 40% undervalued, with potential upside of around 70% to reach fair value. Given Google's consistent history of double-digit earnings growth, many see the current valuation as a bargain. Meta Platforms, the company behind Facebook and Instagram, shows similar potential. Discounted cash flow models suggest the stock could be undervalued by more than 40%, with potential upside exceeding 75%. Since shifting focus away from heavy spending on virtual reality, Meta has delivered strong earnings growth, reinforcing confidence in its recovery. Semiconductors are another critical sector. Taiwan Semiconductor Manufacturing Company, or TSMC, produces about 90% of the world's advanced chips, supplying firms like Apple, Tesla, and Nvidia. Current fears of new tariffs on foreign chip makers have pushed its stock down to around $150 per share, far below estimated fair value of $225. That implies potential gains of roughly 50% once conditions stabilize. Nvidia itself also stands out. Despite its strong growth in artificial intelligence and graphics processing, it is currently trading at valuations not seen in years. Analysts believe the stock is at least 20% undervalued, and many expect much greater long-term growth given its leadership in critical technologies. Taken together, these companies represent some of the strongest businesses in the world, temporarily priced at discounts because of short-term market fear. For investors who can look beyond the immediate turmoil, they offer the potential for significant long-term gains. The larger lesson is that while tariffs and trade disputes create volatility, markets have always recovered. Bear markets are painful but temporary, and bull markets that follow last far longer and deliver much greater returns. Investors who can stay disciplined, avoid panic selling, and use fear as an opportunity often come out ahead. In the end, the current crash is another reminder that the stock market is not just about numbers, but about psychology. When fear dominates, prices fall below intrinsic value. When optimism returns, those who invested during the downturn often reap the greatest rewards. By relying on data, history, and patience rather than emotion, investors can turn what seems like a crisis into one of the best opportunities of their lives. For those seeking to take control of their financial future, platforms like Interactive Brokers can provide access to a wide range of investment opportunities, allowing individuals to participate in the market and potentially build wealth over time. Click the first link in the description to learn more. If you enjoyed this video, please give it a thumbs up and subscribe to our YouTube channel for more great content.